The reason that's uncertain isn't that we don't know what would happen if the tariffs would go on. It's that we don't know what's happening with the tariffs because you can't look in the mind of Donald Trump. Tomorrow, Trump makes the tariffs go away. That would be enough to avoid a recession. But anything less than that is going to cause either a recession or a near recession.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR Mining guy over on X, and of course, your host of this channel. And I'm looking forward to bringing on another first-time guest today on the program. It's Robert Embree. He's a senior economist over at Rosenberg Research, and you can probably guess what we're going to talk about today. We need to talk about the U.S. economy, but also tariff impacts. Of course, threatening tariff wars with China doesn't help anybody. But now it seems like the US and China are getting closer and closer to potentially a trade deal. Maybe that's a bit of strong wording here, but they're getting closer on the tariff situation, which is interesting, a development in itself that we'll talk about. And that's just one of the few topics we'll touch on here in the next 35, 40 minutes with Robert. But before I switch over to my guest, before we get into all of this, please hit that like and subscribe button. It helps us out tremendously, bringing fantastic guests onto the program. And it's a free way to support us. So thank you so much for doing so. And now, Robert, it's a great pleasure to welcome you on Soar Financially. Thank you so much for joining me.
Thanks for having me.
Yeah, really looking forward to this, Robert. And, we have to start with a basic question, which is I usually start off the interviews with it's just what is your assessment of the economy right now, Robert? I need to see where your head is at.
Well, certainly we're seeing dramatic growth slowdowns in the US, in Europe, in Canada, in most major economies. And that's because not only if the tariffs stay on, will they have a dramatic slowdown in growth, but even just the possibility of tariffs creating so much uncertainty. It's creating so many risks for businesses, and it's causing them to delay capital expenditure. It's causing them to delay hiring. And we're starting to see that flow through into the hard data. It's already showing up in incredibly bearish survey data. We're starting to see it in the hard data too. So I wouldn't necessarily say a recession is certain yet. Certainly looks like Q1 GDP in the United States is going to be, if not negative, very, very low in terms of growth. And the IMF, as we know, just downgraded their global forecast. So I think it's fair to call me a bear right now.
No, fair enough. And I think you're not alone out there anymore, Robert, either. I think the voices are getting louder and the signals are getting more and more clear. You just touched on the IMF global growth forecast. Maybe run us a bit through the numbers, because the US was with 2.8% and it has been downgraded. What about the rest of the world?
Yeah, so we're seeing downgrades across the world, and the downgrade for things like Europe, China, all these countries, they're going to be affected by tariff risk, really isn't surprising. The IMF does take into account more bullish factors, like, for example, in Europe, we're going to see a lot of this infrastructure spending and defense spending from the German debt brake reform, but overall, there's so much tariff uncertainty, and it affects so many countries around the world that the IMF didn't have any choice at all but to downgrade global growth numbers. And it's not just the IMF. The head of the WTO went out and said, probably we're going to see at least a 1% drop in global trade numbers. OPEC slashed their oil demand forecast. Every international organization is seeing these global growth declines.
One thing, Robert, has me surprised a little bit, that it comes as a surprise to many. And like on our channel, we've been talking about a global economic decline for the last 2.5, 3 years, and with more intensity as of late, of course. But just based on the market reaction, it seemed like it was a big surprise, like, woohoo, market crash. Were you surprised at all about the reaction, perhaps?
Well, an important question for the last 6 months has been, is Donald Trump going to do what he says he's going to do? And so many people on Wall Street, people who are now tweeting things saying that, oh, well, we never expected this, we're downplaying the fact that Donald Trump has always basically wanted to do this. You can track his public statements back to the 1980s through the 1990s. He has been remarkably consistent that he thinks trade deficits are bad, and that he thinks the existence of a trade deficit in and of itself is evidence of the United States being ripped off, whether or not it's backed by any actual policy. And so the interesting question isn't why is he doing this now? This is what he always wanted to do. The question is somehow, why didn't he do it before? And I think the answer has a lot to do with now he has enough institutional control over his own administration and over the Republican Party to do what he wants. And this is what he really wants to do. And so I think people should not have been as surprised as they were.
Personally, I think they weren't taking him seriously at first. First time I remember Bloomberg comments, it was like, he'll just walk it back tomorrow anyway. When I was watching that, I was like, is the market starting to take him serious now? Like, has that changed? Because that's one thing that probably, and without any judgment, because it probably appealed to me as well, is ego, of course. Like, what, you're a U.S. president flexing to a degree, and the market doesn't take you serious. Like, is that changing?
Well, equity markets basically seem to look for any reason to rally, right? Any conciliatory statement, you get this big rally. And the China-U.S. trade talk rumors that are going around, this is a perfect example, right? When Bessent and Trump talk about a possible U.S.-China deal, what do they mean? Because I don't think what they mean is go back to zero tariffs, and yet the market rallies as if they're talking about a good chance of going back to the old, pre-Trump status quo. That's not what they're talking about. They might be talking about tariffs of 35, 40, 50% instead of 145%. But that's still a very bearish outcome. And markets don't seem quite to be pricing that in yet.
Why are they missing that? Why are they underestimating it? What is your suspicion here? Or
well,
what do you think?
That's a very difficult question to answer. But for the last 2 years, market sentiment has always been rewarded for being bullish. Anyone who was buying dips the last 2-3 years has made a lot of money. And so you have a lot of sort of trend following investors. I think that's one aspect of it. And another aspect is that you're right. There's a belief that Bessent and Stephen Moran and other people in the Trump administration will somehow be able to water this down or contain that. I'm not sure where that belief comes from, but that's very widely held to this day.
How often have you changed your economic forecasts for the rest of 2025, Robert?
Well, I revisit them every month, but certainly on so-called Liberation Day, April 2nd, that caused a big downward revision. We did a big revision to our U.S. forecast, to our Canada forecast, and not necessarily a recession, but certainly something very close to that. And our oil price outlook is similarly quite bearish. And so might change it again next week. Who knows? If there is a big U.S.-China trade deal, that would send the tariffs. I don't expect them to go zero, but let's say they go down to 15%. Well, at 15%, you can still do a lot of trading. And that's a much less bearish outcome. I'm just making that number up, by the way. That's not based on anything, but for example. So there are lots of different scenarios, and you have to think carefully scenario by scenario.
I'm just curious, Robert, and thanks for humoring me on the questioning here. But are you getting less sleep these days? Like, are you waking up earlier to check the news? Like, I'm really curious.
It's been a lot keeping up with all the news, and especially we're a Canadian firm, so we don't just track the global outlook and the U.S. outlook, but specifically the Canada-U.S. tariff file. And on top of all of that, Canada's in the middle of a federal election that's happening in 5 days. So I've been a busy guy. Yeah.
Since you touched on that, might as well follow down that line of questioning real quick. Carney, Polyev, like, how is that changing the economic outlook for Canada and maybe globally as well? What's the impact? What do you think?
Well, one interesting thing about Carney replacing Justin Trudeau is that he has moved the Liberal Party quite a bit to the center and abandoned a lot of Trudeau's unpopular policies, specifically on the tax file, with the consequence that the Liberal parties and the Conservative parties' tax platforms are more similar than they've been for many years. There are also a lot of similar seeming efforts that both parties have talked about to reduce interprovincial trade barriers, encourage more Canadian exports outside the United States, those kinds of reforms. And so while there's some differences on the spending and borrowing side, the policy differences are actually unusually small in this election, which has definitely worked to the Liberals' advantage. Then it sort of comes down to not being about policy as much as who do you want the prime minister to be? And Carney seems to poll very well on that question. So I'd say definitely the Liberals have the edge in all the polling data.
Yeah. And when it comes to relations with the U.S., do you think Carney or Poilievre, who's the better candidate in your opinion? I don't want to get political. I'm just curious on like political policy, like and what they're advocating.
Well, it's a really interesting question. Carney and Trump had a very well-publicized phone call a few weeks ago that by all accounts went well. So there are two interpretations to that. One interpretation is Trump respects Carney in a way he didn't respect Donald Trump, and you should have Carney. Second interpretation is somebody told Trump that he was hurting the conservatives by sort of giving the liberals this rally round the flag crisis trade war. And that's why Trump's been laying off Canada for the last couple of weeks. And that's going to stop next week after the election. So I don't think I lean more towards the former than the latter explanation, but there certainly is a world where this is sort of a false dawn and Trump goes right back to going after Canada next week once the election's over.
Yeah, that might happen. We never know. It's an interesting aspect. The question is, do you have somebody strong enough in Ottawa to can push back, right?
Yeah.
And really hold their ground, because Canada has a lot to offer. It's not like they don't hold any cards.
Right.
To use his own words. Right. But to come back to the overall economic discussion, let's talk about recession. And I mentioned to you, Robert, before the record button, I've been seeing a lot of recession forecasts lately, and they're very high numbers. I just spoke to Steve Hanke, Professor Steve Hanke. He says recession is 90% this year. But even the big banks, J.P. Morgan, Goldman Sachs, they all came up with a recession forecast. And I have to admit, over the last 2-3 years, while we've been talking about recession here on the channel, I haven't seen any recession forecasts being publicized in the financial media, quite honestly. And the forecasts are quite high. Druckenmiller, 60%. I think JP Morgan is the highest of them all, at 60% as well. The others are around 50%. What do you make of that? Why all of a sudden are they coming out saying that? Is it just hedging their own bets and making sure that they look good on whatever outcome happens?
No, I don't think this is hedging. I think that's what all these models are showing. And when we look at several different models, and I read a lot of these other forecasts, and I think this is all fundamentally grounded in what Trump's tariff policy has done, because it has so reduced every measurable survey indicator of confidence. It's reduced confidence on the business side. It's reduced confidence on the consumer side. It's reduced expectations about future employment. It's reduced expectations about future income. That's flowing through into, we're going to see the durable goods report tomorrow. I bet you it looks pretty bad. It's going to flow into manufacturing new orders. And so all of this, even if tomorrow Trump makes the tariffs go away, that would be enough to avoid a recession. But anything less than that is going to cause either a recession or a near recession, if you want to use an ugly term, right? 0.5, 0.6% growth for a few quarters. And so I think all these models they're not hedging their bets. I don't think they're being political.
Yeah, are they missing anything though? It seems like the likelihood of a recession is high. Like as we said earlier, IMF growth forecast down to 1.8% for the US. That's down a full percent. And depending on who you talk to, it's seemingly lower going forward as well. When does it happen? Of course, like how will it play out, Robert? What do you think?
Well, I'll tell you the forecast scenario where you avoid a recession, which is Trump does a complete pivot. We get a big US-China trade deal that Trump can describe as a win. The 90-day tariff pauses lead to a US-EU trade deal and a US-Canada and Mexico trade deal that Trump can describe as a win. And he puts all this behind him and he gets distracted by some other shiny object that he chases. Now, in that scenario, you'd see a big back up in equities and probably some, continued, relief in markets around the world. And you'd still see a growth slowdown. 2025 would still be a slow year. But in that scenario, we would avoid a recession. So if you're saying there's a 60% chance of a recession, the reason that's uncertain isn't that we don't know what would happen if the tariffs would go on. It's that we don't know what's happening with the tariffs because you can't look in the mind of Donald Trump.
Are the tariffs just an accelerator to the whole economic situation? Because we've been talking about a recession since 2023, and it obviously hasn't happened yet. So Are the tariffs just fuel to the fire here? The last drop in the bucket?
The other sort of structural factor underlying all this is the normalization of the labor market, right? So the labor market has been really unusual since COVID-19 pandemic because businesses laid off so many people expecting they could just hire them back. And then in 2021 and 2022, so many firms in the US experienced huge labor shortages that it made them really not paranoid, but sort of strategically nervous. They were reluctant to lay anybody off. They continued a pretty quick pace of hiring, and they kept their job openings really high, and they had a hard time attracting workers. That was the case in 2022, 2023, 2024, and that's one of the biggest reasons why we didn't get a recession in 2023 and 2024 when everybody expected it. What we expected when the Federal Reserve did this massive tightening cycle from 2022 to 2023, usually that causes a recession. Most people thought it would cause a recession. I thought it would cause a recession. The reason most people were wrong is exactly this very unusual labor market dynamic where firms didn't lay people off, even though interest rates had gone up. So what's happened in the last 10 months or so is the labor market's starting to look a lot more normal. The job openings rate has gone way down. The pace of hiring is normalizing. The relationships between unemployment and wages, we talk about things like the beverage curve, if you know that concept. Those concepts all look a lot more normal, which means firms will actually now stop hiring people and start firing people if things get bad. So that doesn't mean that there will be a recession, but it means we're somewhere back to normal in terms of traditional relationships among economic variables.
No, absolutely. And it's one of the Fed mandates, of course, here as well as full employment. We're around 4.1%, which is not too far off of full employment. We're pretty darn close here to it, which actually is a segue to the Fed. We need to talk about the role of the Fed because they put themselves in the line of fire by talking about higher inflation and not necessarily wanting to cut rates, even maybe, I don't think they said it out loudly, but they hinted at even rate hikes. If, the bond vigilantes had their way, and if inflation got out of hand, they weren't talking about stagflation, for example, but again, they could have just talked about it as well. Long intro to the Fed question, but what's the role of the Fed right now, and are they doing the right thing, Robert?
Well, that's the very important question for the Fed is how much inflation risk is there really from these tariffs? Obviously, there's some what I would call mechanical inflation, where like tariffs make things more expensive, prices go up. But it's so disinflationary on the growth side. You would see such a large increase in unemployment, and that would flow through to lower wage growth, which then flows through to lower services inflation and shelter inflation on a lag of 6 to 9 months later. So the growth parts are so disinflationary that I think basically worrying about inflation a lot is an overreaction. Obviously, Jerome Powell doesn't quite agree with that. He has been incredibly cautious, and they, not just him, but other Fed governors in their speeches, have talked a lot about waiting to see things in the hard data, by which they mean they know the survey data, the so-called soft data, looks incredibly bearish across the board. In the last month, it's been almost every survey has been terrible, but they're kind of ignoring that for right now. They want to see it in the hard data. And so that puts them possibly a little bit behind the curve, but it means that if they do start to see it, then I think Fed cuts are going to come back on the menu. And I think they probably will start cutting faster in the second half of the year.
What would trigger that, Robert? Like, what would they need to see in the hard data to trigger that reaction?
Q1 GDP is going to be big. The non-farm payrolls, I think the next one is May 2nd, is going to be a very pivotal data release. Those are ones that they look at. And then they also look at the wage and inflation trend. And so if they see, inflation's only spiking a little bit, but it's headline is constrained. And the other thing that they watch, and this is making their job easier if they want to cut, is energy prices, because that affects headline inflation so much. Energy prices and other commodity prices have taken a huge hit, down double digits since the highs this year. And that also reduces headline inflation. And so they're going to look at all of those things and make a decision. But I would say those are the big four to look at.
No, you just took away my follow-up question here to the inflation debate. It's just energy prices. It's a known target or a known goal of the Trump administration to lower energy prices. Personally, I call it a bit QE for the people because that's what people feel immediately.
Right.
Just filling up their truck. When they save $20, they notice. Let's maybe just get a bit more granular. How important really is the oil price to the U.S. economy, the service economy in general?
Yeah, so the food and energy component of headline CPI is, depending on what measures you're using and what countries, between 20 and 25%. And so it just affects the price of everything, right? It affects the price. Energy prices feed into food prices, of course. They feed into the price of any manufactured goods, and that means that energy prices percolate through the other prices in the economy in this really predictable pattern. So it'll start with the really volatile things, food, other commodities, then it flows into goods prices, then it'll start to flow into, because of overall inflation, you'll see higher wage demands, and then it's flowing into services prices, and then eventually it'll flow into shelter prices. And so right now, that's all happening in reverse. Energy prices have gone down, but it's going to take 3 to 6 months to see that in the lower manufactured goods prices, 6 to 9 months to see it in services prices, 9 to 12 months to see it in shelter prices. But it is disinflationary, and so you just have to wait for that change to show up. But it affects everything in the economy.
Now, personal anecdote real quick, but I was traveling in the US and spending some time with some friends in some hot springs. I was sitting next to a refrigerator repairman, a very specific job, right? But it was just, just north of Salt Lake up in Idaho. And he said he could finally go on that trip again. That was a few years ago, by the way. But he could finally go on that trip again because oil prices dipped and he could fill up his truck for way less. Right. And that just really, that's where the penny dropped for me. It's like oil prices and gas prices are really, really important to the US economy. Because it's like they're so tight on credit. What do you call it? It's like the savings rate is low anyway, but
Yep.
it's a very tight ship they're running on their personal finances to a degree as well. So it has a huge impact. Just a personal anecdote, but it really highlighted to me how important that is, and I think that's why I call it QE for the people because they feel it directly.
Yeah.
Right. To talk about commodities, let's shelf the commodity debate for a second. I just want to talk about the bond market real quick. Sure. What kind of signals are you getting from the bond market right now? Yields jumped up aggressively for 3.8 to 4.4, 4.5, but now they're hovering around that level. Panic that everybody expected hasn't set in. Bond yields stopped rising. What do you make of the bond market? What is it telling you, Robert?
So we pay a lot of attention to different measures of uncertainty and risk in the bond market. And one of those ways of thinking about uncertainty is what's called the term premium. So the term premium is a measure of basically how much you have to compensate investors for holding long duration, meaning 10-year or 30-year bonds in the Treasury market, as opposed to just 2-year. And that, for various reasons, that's associated with uncertainty. When uncertainty goes up, investors are more concerned about the future and they demand higher yields, and that's a higher term premium. Well, since Donald Trump's election, that term premium has gone through the roof compared to where it was before. It's actually negative for a long time for various reasons. Now it's well into positive territory, and that's a measure we track really closely. So that's a sign of some distress in the bond market. I think it was down a little bit today on Trump's walk back of his Powell firing comments. But when he goes out and says things like, I might fire Jerome Powell, that's exactly the sort of thing that long-term bond investors are terrified of, because that would mean a potential end to Fed independence. And then who knows what that does to the Treasury market over the next 10 years. And so Donald Trump and his policymaking style of made for TV policy announcements with so much uncertainty, that's increased the perceived uncertainty in the Treasury market. So that's one piece of it, is that sort of uncertainty component affecting the longer end of the curve. Then the other part of it is the economy is really bad, probably the Fed's going to cut rates. And that should tend to be bullish for the bond market, especially for what we focus on, which is some of the shorter duration bonds that are more sensitive to Fed rates, and medium duration bonds, 5 years, 7 year, those sorts of things. And so netting those two things out is really difficult.
We've seen a few bond auctions go, what do you call them? Like go successfully. I was missing a verb here, but get what do you call them? Completed, or just get done. Maybe
Right.
That's the right word.
Yes.
Right. Any indication of stress there? It seemed like everything went fine.
Right. The bond auctions have been okay. I think there was only one where they had some temporary problems. Almost all the other ones in the last month or so have been fine. But there is signs of stress in what's called the CDS, the credit default swaps spread. So CDSs are basically a type of insurance that you can buy that compensate you for treasury default risk. Now you might say to yourself, well, surely treasuries are basically risk-free. Why do I need this insurance? Well, you can insure against any risk in the really liquid financial markets like treasuries. So looking at that spread, that's something that we track really closely, and it hit 50 basis points yesterday, which is the highest since November 2023, when there was, if you recall, some congressional wrangling around the budget at that time, which also tends to elevate these spreads. So that's a sign that investors are still concerned. The treasury market has not normalized, and I would advise people to really closely watch that CDS spread going forward.
Interesting. The CDS spread itself, I haven't heard too much lately, so it's an interesting, what do you call it, tracker, right?
Exactly.
A temperature gauge here as well going forward. It doesn't sound like you're too concerned just yet, but you're keeping a close eye on it.
Exactly.
Okay. No, makes a lot of sense. Last big topic before we get to commodities is really the US dollar. We got to talk currencies. You're based in Canada, of course. You're being hard hit on the currency side. For me, as a European, I love traveling to Canada because everything's so much cheaper. But in general, what do you make of the currency situation, the role of the US dollar? It's another one of those tier one assets. What do you call it? Oh, sorry, it's getting late here. I'm losing words. I don't apologize for that, Robert. But it's one of the assets the BIS has classified as a tier one asset. Let's
absolutely. It's central.
Exactly. What's the role of the US dollar? We've seen some weakening. Maybe was the dollar overvalued? Is it fairly valued right now? What do you make of the trend right now?
I would say it might still have a little more room to fall, in particular if the tariffs do go on, right? The interesting thing about this is that the dollar rallied so much from November to January. And that's because typically people think that tariffs are going to be bullish for the country that's imposing them, right? It should help, manage your trade deficit, and maybe you'll import less, and therefore your currency will rally. And so there's this big Trump rally in the dollar. And then when Trump actually rolls out the tariffs and does it in a shocking way that wasn't telegraphed, that emphasized uncertainty, and that led to what seemed a lot like capital flight from the United States. So since these tariff announcements, the dollar has fallen against every major world currency. The euro's up over 10%, the yen's up, the British pound's up 7.5%, gold is through the roof. And so we've seen sustained dollar weakness driven in part by investors rebalancing their investment portfolios away from both US equities and US bonds and selling dollars in the process. Now, that doesn't mean, the dollar's lost its central role. You see these media headlines that are just ridiculous. What it means is that the dollar's depreciated. It might continue. If US growth continues to decline, it probably will continue as US equities start to look, continuously less attractive, right? So that's all that it means. People shouldn't panic, but we do think that diversifying away from the United States makes a lot of sense given that dollar weakness. We're pretty bullish on the yen. The yen is one of the most undervalued currencies on a fundamental basis. We're still a little bit bullish on gold, which I'm sure we'll talk about. Still bullish on the euro, given the European growth prospects probably look better than American ones in terms of difference to expectation right now. And so there's a lot of downward pressure on the dollar still to come.
Do you think that capital will ever return to the U.S.? I think that's been a topic of debate. in markets, capital allocation, capital controls to a degree as well. Pension funds saying we're not going to invest in the U.S. anymore. This is ridiculous. I think it was a Danish fund that sort of, again, I'm paraphrasing a little bit, of course, here, but I think it was a Danish pension fund that said we were moving our assets and our money out of the U.S. and investing it domestically or within the EU. Like, do you see that trend continue strengthening, or is it just let's call it media hype?
Well, the old joke about media stories is that 3 events makes a trend, right? So has this happened at least 3 times? Yes, and you're going to see media stories. But the United States still has the deepest and most liquid capital markets in the world, and that's true on the stock side, it's true on the bond side. It has New York, which is the center of the world's financial system. If you are an asset manager in Europe or Asia, and you are saying to your clients, we're going to deliver outsized returns and not buy any American assets at all, that seems implausible. So that's not really what it's about. It's not about people boycotting the US. It's just about rebalancing. If you're cutting your US exposure from 70% to 60% or 50% to 40%, then that does affect asset valuations. And in particular, if you see that trend continuing, at current levels, US equity markets still have much higher PE ratios than a lot of other developed economies. And so you might expect to see some equalization in those valuations, and that would be very bearish for the US stock market.
No, I think we can all agree that even today at current valuation, the US stock market is still quite pricey, and it needs to catch up to its valuations here a bit. Right. Or the companies need to catch up to the valuations.
Exactly. And so a lot of that is, do you believe that AI and a lot of these other productivity gains are imminent? They're about to happen. They're going to flow through to the bottom lines and the profitability of all these big American companies. Because if you believe that, you need to still hold those US assets. And that's the question.
Yeah, no, absolutely. Liquidity you touched on, I think, is essential here as well. We're going to park $760 billion, for example, like the China. Like, where are you going to park it? There's no other liquid enough market that you can do it. So, right. To commodities, you brought it up. We need to talk gold. It's the #1 asset on the planet right now. Everybody's flocking seemingly into the precious metal. Why is it the only one standing right now that's doing great? As we said, bond yields are up, dollar down, gold up. What do you make of that?
Gold is a really unique asset. Gold and other precious metals, right? So silver is very correlated with gold. We've seen some strength in some of the other, platinum and some of these other precious metals. But gold is the big one. It's very different than other commodities because its uses are primarily as an asset rather than for industrial use. I mean, people buy jewelry. There are some industrial uses for gold, but the gold market is dominated by people buying gold as a financial asset and central banks buying gold as a reserve asset. And that makes it behave differently than other assets. Gold is historically desirable because it has a very low correlation of price changes with a lot of other major asset classes. So that makes it a valuable diversifier when you add it to a portfolio. That's why it has this really desirable property. It tends to hold its value in a lot of different environments. So when there's a lot of uncertainty, when there's downward pressure on the dollar, those 2 factors are both bullish for gold. So that's why we've seen this huge rally in gold. We've seen an increase in uncertainty and downward pressure on the US dollar at the same time, and that's a recipe for a gold rally.
And that's exactly what we're seeing, what we're witnessing, and gold reacts quite strongly to market news, saying U.S.-China tariff, agreements, and there's the second topic of debate. Oh, Jerome Powell's firing was the second one today. So
right. Absolutely,
or not firing, no intention of firing Jerome Powell. So it seems like somebody whispered in his ear that this might not be worth the trouble. So we'll see where it goes. Interesting discussion here, and quick follow up to the gold debate. Silver hasn't caught a bid in that regard. Like, it's absolutely been ignored. In relation, besides today, by the way, the day we're recording this, what is it, April 23rd, silver is actually catching a bid, and the gold-silver ratio dropped below 100 again. But what do you make of silver right now?
Yeah, well, both silver and gold mining stocks have both kind of lagged behind gold a little bit, which is really, really interesting. And if you believe historical trends, probably would have some catch up, right? So if you missed the boat on gold, I do think that silver, certain types of gold mining stocks, and certain other, regions of the world that will benefit from gold. If you want an even more lagged play to get some gold exposure, you can look at things like South African bonds, which have a gold correlation, right? So there are lots of interesting asset classes you can explore.
Now, it's an interesting phenomenon how silver and the mining stocks, as you said, behave as well. I just had lunch with a journalist here in Germany, and we were just sitting here shaking our heads. Like gold goes down 0.5% or 1%, the stocks crash 10%. Like same with
Right.
the copper stocks, by the way. But gold in particular is puzzling because we're still trading at around $3,300 US an ounce.
Yeah,
And yet,
and that should be well above the break-even point for so many producers, right? I mean,
hopefully for all of them.
Hopefully for all of them.
To be honest, no, Robert. If I were to come to you in the Monday morning meeting, you say, Robert, we were looking to allocate a big amount of cash, or Kai is looking to allocate a big amount of cash, based on what we just discussed, and it's a nice summary question. That's why I like asking it. It was like, how would you allocate my money today? And no financial advice or anything, Robert. It's more of a summary of what we discussed.
Yeah, exactly. And I always say to people, probably should have said this at the beginning. I mean, this isn't necessarily an investment advice in the sense of do exactly what we said. We try to analyze top-level macro trends to help people have a more informed picture and make informed decisions. But we see a lot of value in a diverse international portfolio of bonds, right? So government bonds and to some extent international corporate municipal bonds. But, European bonds look good. The ECB is probably primed to ease more quickly than the Fed. That's probably true in Canada. That's probably for other reasons because of the yen exposure. I think Japanese bonds and Japanese equities are also a good thing. So I think if you want exposure to a global easing cycle and a global growth slowdown, and you also want exposure to a declining US dollar, I think a diverse portfolio of international bonds is a really good place to start. If you wanted to go further, you could look at some emerging market bonds too.
Fantastic. No, Robert, really appreciate you coming on here. Really enjoyed our conversation. We'll have to do this again soon. Catch up maybe in 6 months' time, see where we stand on the tariff war and how it really played out and has it led to a recession. I think that's the
6 months from now, we'll have some whole new Donald Trump policy that we can talk about, and who knows what that'll be.
Absolutely. I'm hosting a podcast. I wake up every morning and I don't know what to talk about, quite honestly, because it's too much. It's too much. Like it's difficult to focus on a single topic, quite honestly. That's why I try to touch on a lot of different asset classes here and try to make sense of what is going on. Robert, where can we follow you? Where can we send our viewers?
I'm on LinkedIn, and David Rosenberg and I both have frequent media appearances up here in Canada. So thank you very much for having us on.
Absolutely. Really appreciate your time, Robert. Thank you so much. And thank you, everybody else. Thank you so much for tuning in to Soar Financially. Here from the road, I'm traveling in Germany today, so I really appreciate you watching us today. I hope everything went fine, and appreciate you appreciating that I'm not wearing a black t-shirt today. I'm wearing actually a suit. So I hope you appreciate that. Thank you so much for watching. Make sure to hit that like and subscribe button, and I'm not going to say appreciate again. So thank you so much. Take care.